Welcome to Less Than 15, a show for busy business owners brought to you by DFK Australia, New Zealand. Each week we deliver bite-sized, actionable insights from industry experts so you're across the issues that really matter. I'm your host, Angela Rasmus. Let's dive into this week's topic. Hello and welcome back to another episode of the Less Than 15 podcast. Today we are travelling across the Tasman to Auckland and our guest is Mike McNab. He's a partner at DFK Oswin Griffiths Carlton in Auckland. And the thing that is really important about today's conversation is the fact that Mike and his team have so much experience in business performance improvement, with a special bent on technology helping us monitor and get the feedback that we need to improve our businesses. So the topic that we're diving into today is profit doesn't mean anything if cash flow is not behaving itself. So welcome, Mike, and thank you for spending your time with us.
Not a problem. Thanks for having me. Really looking forward to it.
So let's dig into that number one question. Why is it that a profitable business that appears to be doing well can still fail because of cash flow issues?
Well, I think there's a common misconception that if I'm making profit, I must have cash in the bank. And to be brutally honest, that's not necessarily always the truth of the matter, because profit is an element of issuing invoices to customers, receiving invoices from suppliers, paying wages, paying rent. And there's always time delays with respect to when a customer will pay you and when you pay a supplier. And those time delays have the impact on the cash. And that can create a lot of confusion, because many clients that I deal with, and I literally just dealt with one today, they looked at their profitability and said, well, my profit's $240,000, but I've got $10,000 in the bank. That doesn't make sense to me. And I had to go through the process of explaining to them that just because you have a profit doesn't necessarily mean it's going to be cash. And here's why. And we literally pulled apart his balance sheet.
That's where we have to pause and dig under the surface, as you did with that client. And with the years of experience that you have and across many, many different industries, what do you see as, let's say, the 5 biggest cash flow killers? Where are our Achilles heels?
First of all, you've got expense creep. So where business owners are not monitoring what they're spending, they think they're okay, we can just do it, or they rely on other people to purchase for them. You've also got wastage or inefficiency. So for instance, you might have really bad stock control. So particularly say if you're in the food industry, food products can go off. Or you might have excess labor costs. So in other words, you're not actually budgeting the labor that you need for the revenue that you're potentially going to generate. You could have a drop in sales because of seasonality. So like, for instance, just over Christmas, or the area that you're in is, say, a high crime area that creates problems. People won't come. You've also got time lags on people paying you for the products that you sell, and also time lags that you have when you're paying other people. Also, another big one is basically lack of visibility on what's actually happening with the cash flow. So not actually looking at things on a day-to-day basis.
I guess that's where technology can play a really important part as well. So we've looked at those 5 Achilles heels, and I'm assuming they're different depending on the type of industry that you're in.
100%. I mean, if you look at, say, for instance, with expense creep for like wages, typically that's going to be where you're either in a manufacturing environment or say hospitality, where you're rostering people to work certain hours to do a certain task. That's where you can get creep, where people want extra hours, so they're friendly with a manager, the manager puts them in place, they get the extra hours, but the business owner's not getting that productivity from those people. They're just getting paid extra time or extra money. So that becomes really, really important. It is a kind of a horses for courses thing. it will vary industry to industry and business to business, depending on how the managers or the owners or the operators actually look and consider what's important for them or what drives their business in respect
To be
of
aware and be
profitability.
vigilant, because it's easy to take your eye off
Yes,
the ball
very
if you're
much so.
being pulled into another area of the business. And a lot of our business owners are juggling many
Correct.
balls, but this is one that's a glass one as
100%.
opposed to a rubber one. We can't drop this one.
Correct. And also it becomes more important when you're in the middle of a recession or where there is an economic downturn. When the economy is relatively buoyant, people will spend money and there's a free flow of money. But when you get to a point where inflation's high, unemployment's high, people are losing jobs, industries are contracting, that's where you should be looking to really focus in and hone in on cost control, monitoring cash flow, really looking at the things that make your business tick.
So everyone is going to have some of these cash flow challenges. It's part and parcel of running a business. What are some simple, actionable tactics that you suggest where we could focus our attention? Again, little asterisks, knowing it'll be different for different organizations.
Well, if you're issuing invoices to customers, the first thing you should do is really focus in on how quickly are you collecting those invoices, and identify those customers that are really, really good, because they're out of any group of customers, you always have a few that are exceptionally good and pay on time. You'll always have some that might be a couple of days late, and then you'll have what I call the stragglers, where they will just pay when someone picks up the phone and calls them. They'll stretch it out as long as they can. So look at your customer base, look at their payment history, work out where your pressure points are. The ones where they're a couple of days late, you've got to keep an eye on them. And your stragglers, they're the ones you've really got to focus on and put the pressure on them and work with them to get payment earlier, however that may be, whether it's installments over the course of the month. So that would be one thing.
So recognizing
really
those patterns.
Yeah, very much so. I mean, receivables for a business is the lifeblood. And if that blows out, then that contracts the available cash that you have to spend before you even think about, well, what costs have I got within my business? Do I have multiple sites? Can I rationalize those costs by combining contracts with one supplier to get a bigger discount? Can I look at my workforce? Have I got hour wastage? Or if I'm doing food, look at my food costs, my ordering. Am I over ordering? Is my food wastage too high? Again, a simple thing that can be done, but a lot of business owners don't necessarily have the time to watch it. Because, as you say there, it's like a helicopter. They've got so many different hats. You know, they're HR, they're marketing, they're sales, they're fixing something, they're bringing in new people, they're training people, they're dealing with the bank, and then they've got their family on the side as well. So being an owner of a small business is a very, very difficult thing.
I mean, let's acknowledge that it has a lot of rewards, but it also takes a lot of effort. And I think one of the things that we were talking about, the invoicing and having that pattern recognition and where to focus. A couple of things you've touched on that can actually speed up that cycle around perhaps offering some flexible payment options, or even looking at how you might discount if someone pays early. Could you speak to those for a moment?
Yeah, I mean, those are considerations. If you think about, say, a power company, for argument's sake, they issue hundreds of thousands of invoices every month to all of businesses and homeowners. In order to keep their data management in line, they offer a prompt payment discount. So what they've done is they've weighed up, well, what's my opportunity cost for having someone owe me money over and above the due date? What does that cost me? as compared to, well, if I give a little bit away, will I get that money faster? So prompt payment discounts are always a good option. The other option you can also consider is if you know that you've got a client who, or a customer you deal with on a regular basis, but they're always really slow at paying. But typically you bill them the same amount every month or very close to it. What you can do is go to them and say, well, look, if I'm going to bill you, $3,000 for the month, how about what we do is, instead of me giving you an invoice and me chasing you 60 days later, why don't we start a weekly payment system whereby we start with $3,000, spread that over a weekly payment plan. So over a 4-week period, you pay me a certain amount each week. That means your cash flow is not as impacted. I'm getting my money kind of in advance, and everyone's
so again,
happy.
what I'm hearing here is proactivity. Being proactive is really important. I guess where we can tie this up with a little bit of a bow at the moment, because one of your areas of expertise is the tech side. So how can technology or the systems that we have make this easier?
Well, if you're a Xero user, for argument's sake, there are already tools built into Xero that allow you to kind of monitor certain KPIs without spending any extra money to upgrade your subscription. So within Xero, they have a cash summary, which you can run on a daily, monthly, weekly basis, which tells you where your money is going and come from at any point in time. You can look at historical trends for that as well and compare different periods. So this period to the same period last year, just to get an idea of how things are going. Also within Xero, they have a short-term cash flow business model, which what it does is it looks at what invoices you've issued, what invoices you've received from suppliers, and it works out what short-term cash flow is, whether it's a positive or a negative. So again, you can use that very, very quickly to work out, am I going to have a cash deficit in 20 days? Or, based on projections, I'm going to have a cash surplus because my customers are going to be paying me, and then I can pay my suppliers. So those are two very quick, easy tools. It's all set up in Xero. You don't need extra subscriptions. There are other software tools that are available. There's a product called SYFT, SYFT. We use it for a number of our clients where we're literally monitoring top customers, top suppliers, how are we paying them, looking at the trends over a 2 to 3 year period on a month-by-month basis. And again, what SYFT does, it works really, really well with Xero. It drags in all the transactions line by line.
So we'll make sure we put a link to SYFT into the show notes as well. I know Xero, I use it myself, but that one was a new one for me. Well, thank you so much, Mike. What we're really hearing here is the visibility and the proactiveness. Don't wait until it bites you. Get out there and start taming the lion, which obviously your bookkeepers, accountants, business advisors can all assist with. So if we leave with an action that a listener can take right now, what would you say is the most important thing?
Most important thing is, don't assume that people are going to pay you when they say they're going to pay you. Be ever vigilant on the collection of cash, and be ever vigilant, particularly with people who are paying cash on your behalf or arranging payments. Make sure you have overview of all of that. And I know it's a really hard thing to do because as small business owners, we are exceedingly busy, but it's really important to take 10 minutes each day. If it's at the beginning of the day or at the end of the day, where's our cash? What have we got? What's due tomorrow? What do we expect to come in tomorrow? So that you don't have surprises and one of those moments where you look at your bank account and go, I thought I had more money
Absolutely.
than
So it's
that.
all about keeping your finger on the pulse. So thank you so much for your time today. It is food for thought for our listeners and our viewers as well, to go check out what are those levers, the emphasis on collecting cash, connecting and utilizing some of these tech tools so that you can be both profitable and have a great cash flow. So thank you very much, Mike.
100%.
And
My
until
pleasure.
next time, take care. We look forward to welcoming you back to the next Less Than 15 podcast. We hope you enjoyed this episode of Less Than 15 and have a fresh idea or two to take action on. Hit the subscribe button so you catch every bite-sized business bulletin. And we'd love you to leave a review or perhaps share the episode with a friend. Less Than 15 is brought to you by accountants and business advisors DFK Australia New Zealand, helping business owners make better decisions through local knowledge, national connections, and global reach. We'll be back next week with more valuable insights to help you and your business grow.